this isn't a partisan issue. This is a retirement security issue that affects every American across the country. Doesn't matter what your political leanings are. Social Security really matters. Even folks who have a lot saved in their 401ks, they can expect to get up to $1.5 million in terms of current value for their retirement benefit. And who's going to sniff at that?
All right, welcome everyone. Welcome to another episode of the Advisor Upside Show. My name's Sean. I'm executive editor here at the Daily Upside. I'm alongside John Manganaro. He's our reporter, covers everything retirement. Welcome, John. How you doing?
Good, Sean. How are you? The summer's flying along. I can't believe we're already thinking and planning for August. It's pretty wild.
Summer's flying. Yeah, as usual. I got back from vacation. I'm feeling well rested and ready for another episode. And this episode is going to be a good one because we're going to talk about a couple big stories that are happening, big trends in our industry. One about some new tax efficient, very innovative ETFs that the Treasury and some other folks are looking at. And then, John, why don't you tell us a little bit about what you want to talk about as well?
Yeah. I recently reported a story about inflation and how that will affect people's Social Security benefits next year. Pretty interesting story. Good news, bad news, I think. We're always looking for the upside of stories here at the Daily Upside. So I wanted to highlight, one sort of positive element about higher inflation, if we could say that. It's hard to say that higher inflation is a positive thing, but next year, people's benefits, could get a nice little bump. But we got a lot to cover. Why don't we jump right into the first segment?
Let's do it, John. John, we wanted to dig into some of the reporting you've done this week and last week about inflation and retirement security, because consumers got a welcome reprieve from rising inflation in June, thanks largely in part to some plummeting energy prices. The cost of crude dropped 25% during that month. This month is a different story, and renewed conflict in the Middle East that's not ending anytime soon is a big reason why. It's bad news for consumers in general, but there is one silver lining, if we can say that, for Social Security beneficiaries anyway. Inflation data from the third quarter is used to set each year the cost of living adjustment for the following year. So higher energy prices in the next few months could actually be a good thing. What's going on there, John?
Yeah. It's a really interesting story. And, here at the Daily Upside, we're always looking for, an upside in the headlines. And of course, folks will be very well aware of the high cost of energy right now. I recently drove from Pittsburgh to New York. I was visiting family and I felt the pinch at the gas pump. It's pretty painful to, to fill up the tank these days. In general, that's bad news for consumers. It puts a strain on the economy. But as you said, Sean, inflation each year in the third quarter is used to adjust people's Social Security benefits for the following year. So recently, the Senior Citizens League projected a 3.8% benefit boost next year. That would be about 1 percentage point higher than this year's increase of 2.8%. And it could increase meaningfully if inflation remains high during this quarter. And that seems to be what we're experiencing. We won't have July's report for another few weeks, so we can't say for sure exactly what the first month of the third quarter will be, but chances are it's going to be a decent inflation number. Just some data, inflation pressure stemming from the supply chain issues and other causes delivered a COLA of 8.7% in 2023. I don't think it's likely we'll see a COLA quite that high next year unless we see some other, causes of inflation beyond energy. The highest COLA in recent, quote unquote, recent history was 14.3%, which was implemented in 1980 in response to severe stagflation and the energy crisis of the late 1970s. A little bit kind of scary to think about, what a renewed energy crisis could do in the current moment. It's something that we've had to navigate before in the past. But for added context, a 3.8% COLA for next year would be above the roughly 2.6% average COLA over the past 20 years. In dollar terms, if that took effect today, average benefits would rise from about $1,900 to $2,011. So, a little bit of a boost. The bigger story, though, really is what's going to happen with inflation in the coming months. There could be a bit of a sweet spot, Sean, if energy prices kind of remain a little bit higher for the next several months and then come down. That could really give people a nice benefit boost at the same time that the core inflation kind of reduces. So pretty interesting story. Definitely something we'll be following in the weeks and months to come.
For sure. Yeah. So, and you said we're not going to know the July inflation numbers for a few more weeks, right? But it does seem like the headlines are making it seem a higher COLA is probably likely, right? I mean, we see, like we mentioned at the top, the war in the Middle East is expanding pretty meaningfully. I think there's been another ceasefire in the last few days, but we'll see where that goes. And there's other countries getting dragged in, including Saudi Arabia and others. Is it
Yep.
fair to say that every Social Security COLA is a bit of a missed blessing? I mean, there's always geopolitical, there's always different things and different things weighing on these decisions and these adjustments. So how do
Yep.
you kind of square that?
Yeah. It's when I speak to experts on this topic, Sean, they really often kind of use the metaphor of treading water. I mean, I don't think very many Social Security beneficiaries are out there celebrating the COLA each year. They really feel the higher cost of living. I mean, a lot of retirees, it's in the name, right? They're retired. They don't have income. They're not participating in the labor market where they can sort of negotiate higher wages. They really rely on their Social Security benefits and their savings and investments to navigate retirement. So it's absolutely a mixed blessing. I mentioned the Senior Citizens League earlier. They've done some really good research just showing, how retirees have lost substantial buying power over the past, several decades. They often talk about the fact that the Fed's preferred inflation gauge that is used to set the COLA doesn't accurately reflect just the pressures that are facing seniors. So, for example, seniors tend to spend more on healthcare, more on things like prescription drugs, less on necessarily travel and energy. So their inflation gauge looks a little bit different from the typical worker, and for that reason, seniors have really been losing buying power. So no doubt that it's a mixed blessing. This also makes me think of something else I mentioned in my article, Sean, which is the reintroduction of the Social Security 2100 Act that was reintroduced by Rep. John Larson of Connecticut. He's a Democrat. The bill would kind of address some of these things and try to make Social Security benefits feel less like treading water and a little bit more like, the robust retirement benefit that people feel that they've earned. One thing in the bill is raising benefits up by 2% across the board and setting a new minimum benefit at a 125% of the federal poverty line. I think that would be a positive development. Additionally, the Social Security 2100 Act would increase the Social Security payroll tax and expand it to cover income over $400,000. Larson said that would shore up the trust fund for an additional 32 years. So that would be positive. Of course, it would be a little bit painful for workers to see the payroll tax go up. But interestingly, again, referring to the Senior Citizens League and other organizations like the Registered Social Security Analyst Group, they've done a lot of research that shows that most American citizens, they'd be happy to make that bargain. They are willing to pay a little bit more in taxes if it means making sure Social Security will be there for current retirees, for future retirees. Unfortunately, govtrack.us gave the Social Security 2100 bill a whopping 0% chance of passage in the current Congress. It's a little bit sad to see because, Sean, we've seen retirement be a pretty, bipartisan issue in Congress. We've had things like the Secure Act 1.0, Secure Act 2.0. So it really does seem to be one area where Congress can sort of get the ducks in a row and actually, produce bipartisan policy, which has been great to see. One good piece of news, I think, is that the Social Security 2100 Act just kind of raises the topic. It got some coverage in newspapers. General publications have actually talked about it, which as a retirement reporter, I think that's very positive to see whenever like these sort of niche topics and bills actually get attention and get people talking about the current status of the Social Security program. So at the very least, that this bill has sort of raised the topic in the broader public, and I think that's a positive thing. We'll see again, very low likelihood of passage this year, but who knows, maybe next year.
0% chance. So you're saying I have a chance from coming over. So that's you're right. At least the discussion is being had, and there's some things on the floor at least to get at least the country's kind of mindset about thinking about these issues, because they probably can't stay the way they are.
I'm sorry to interrupt you, Sean. Just to remind the listeners, they may know this if they subscribe to the Retirement Upside, but we're looking at a Social Security trust fund insolvency date of roughly 2032, potentially 2033. They can play around with the trust funds and sort of combine the disability fund with the retirement fund and sort of eke out another 6 months to a year. But that this is going to be an issue for the senators who are elected in November of this year. They will be in the driver's seat in that, critical 1 to 2 year period before trust fund insolvency. So this is 100% an election issue this year. I really think folks should be, I'm a big advocate of, contacting your representatives and senators. And this isn't a partisan issue. This is a retirement security issue that affects every American across the country. Doesn't matter what your political leanings are. Social Security really matters. It matters to people who don't have a lot of resources for retirement, but it's also a substantial benefit for even folks who have a lot saved in their 401ks. They're the typical couple out there, they can expect to get up to $1 million, up to $1.5 million in terms of present current value for their retirement benefit, and who's gonna sniff at that? I mean, it's a very important thing, and advisors should realize that this is even though their clients hopefully have a lot saved and are looking at a pretty a positive retirement outlook, Social Security still matters for those people. So that's the bottom line.
It's funny. It seems like it wouldn't be a partisan issue, but we'd be surprised these days how everything gets partisan. Well, back to the good news that we had at the top of this segment. It is good news possibly for Social Security beneficiaries. And it is a reminder that energy prices, they matter and matter a lot. And we tend to think of today's economy as driven by the AI and the software, but the situation geopolitically and in the Middle East, it reminds us that energy is one of the more fundamental inputs of anything we buy, and fundamental obviously to the economy. Oil and natural gas prices still ripple through even decades after the energy crisis of the 1970s, which you alluded to with some of those COLA adjustments. So let's hope we're not heading to another stagflationary energy crisis. Hopefully not. But again, in the short term, maybe some good news for Social Security beneficiaries next year. So thanks, John. A lot to unpack. We appreciate it.
Yeah, it's an interesting outlook, Sean. Let's hope and pray we're not heading back to the 1970s. I'm curious for our listeners out there, what do folks remember from that time period, and separately, how are they sort of adjusting and addressing, the shifts in inflation? It's really difficult to sort of envision where this is going. So I'm curious, how people are responding to that in real time. Advisors out there, if you're doing anything interesting or innovative to sort of respond to this moment, we'd love to hear from you. Sean, we always love listener feedback, and as folks have information to share, we love to include them in the newsletters and in the podcast. So I would just encourage folks to get in touch with us. We're both very, very easy to contact. Our contact information is right there on the website. So if folks have ideas or want to get involved, I think they should reach out. What do you think?
We love compliments. So yeah, keep them coming, and any critiques as well. It'll make us better, but we'd love to hear from you. So yeah, please drop us a line.
This episode is brought to you by the Retirement Upside. Let's face it, there's nothing simple about retirement planning. When should your clients claim Social Security? How much can they safely withdraw each month from their 401k? What about the right mix of stocks and bonds for a 30-year retirement? Don't even get me started on optimal Roth conversions and inherited IRAs. I could go for hours. We launched the Retirement Upside to bring you the answers to all of these questions and more. We come to you in your inbox every Friday morning with the latest news and expert views affecting your clients as they prepare for and navigate life after work. Subscribe today at thedailyupside.com. For this segment, we wanted to highlight some of the work of our newest colleague here at the Daily Upside, Quinn Waller. She joined us recently to help expand our wealth management coverage, and it's been great having her on the team. It's super exciting to see the team grow, Sean. I love the momentum we have here at the Daily Upside. We have new ideas, new projects in the work that people will see, coming out later this summer. So super exciting. But Quinn's story, and you edited, Sean, she wrote about some comments made by the Treasury Department officials regarding a wave of new tax alpha ETFs. Sean, you're a bit more of an ETF expert than me, and I think you've been sort of tracking this issue for some time. So what's sort of the background here, and what did Quinn's story kind of get into?
No, it was interesting from last week, and I think to take a step back. So these tax alpha ETFs, as you rightly call them, basically they're a way for clients to defer capital gains tax. So they take appreciated assets or stocks, they pop them in the ETF and use the in-kind redemption mechanism that we all know and love about our ETFs and makes them so tax efficient to basically swap those assets out for fresh shares of stocks that have much lower tax bills. So investors essentially can avoid having to sell those positions And it's something we've seen explode in recent months. And it allows clients, like I said, with those highly appreciated stocks, whether they're either concentrated or appreciated or both, maybe they just sold a business, maybe they worked at SpaceX and they, now went public and they have all these new positions. It helps them to avoid it. Of course, they'll have to sell the ETFs eventually. So proponents say it's not tax avoidance, it's tax deferral. So they can just kind of kick that down the line. When they do sell that ETF that's holding those underlying stocks, they're still going to have to pay taxes on that. The caveat being a lot of people won't sell it and they'll just take it to their grave and pass it on to their inheritance, and they'll get stepped up the basis points on that. But the interesting part of the story, which you alluded to correctly, was that Treasury officials recently called the new funds too good to be true, and also even abusive at an event. And that was per a Bloomberg report. And like you mentioned as well, Quinn did an excellent job unpacking that. And they were really talking about what's happening with the increasingly popular 351 conversions. So that takes those appreciated stocks and just starts a whole new brand new ETF, and it seeds a new fund with those stocks, uses those same mechanisms to kind of churn out those stocks and get rid of those the taxes that should be paid on them. They become one of the most popular strategies in recent months. I mean, at the ETF industry shows, you hear a lot about these helping really wealthy folks that have their own businesses. Maybe they're selling their business, take all of that money right into an ETF, and you can defer, as I said, those stocks. Quick numbers, 105 ETFs have been created through these 351 exchanges alone. And that's more than half of those were in the past year. So this has been around since, I think, 2019 with the ETF rule that allowed for a lot of these expedited launches. Just in the past year, we've seen more than half of them. The funds also helped defer $6.5 billion in capital gains, just the 351, not any of the other strategies like heartbeat trades, et cetera. It's something that's certainly gaining attention around the industry for sure, for better or for worse, but it's here.
Yeah. I'm glad you mentioned the sort of step up in basis topic, because that's something that comes up in my reporting frequently, on the retirement and estate planning topic. It's an extremely powerful sort of tax management technique. Of course, you don't get to enjoy it yourself as the owner or the creator of that wealth, because it requires you to die, to pass away, to get that step up in basis. But it is a very important technique that I read and write a lot about. Of course, it's to the tremendous benefit of your heirs, which I suppose is a positive thing. Pretty
quickly
interesting.
on that, I mean, I think if you're an advisor and you don't recommend that your client holds on to these 351s or any of these tax alpha strategies and actually sells them before death, probably weren't the right recommendation, right? Because you could have a huge tax bill when, if you just, like you said, stepped it up, then they would be essentially gone.
Something else we've reported on is, experts have kind of suggested that a crackdown aimed at a handful of aggressive strategies could accidentally affect other ETF investors, ordinary ETF investors, you could say. We've seen sort of that happen in the past, sort of specialized products that are spilling over it's really caused issues in other areas, but I'm curious what you've seen there. My sense, just as a person kind of following the ETF marketplace and the SEC from a bit more of a distance, is that, the current SEC doesn't seem to really have an aggressive hand and doesn't really want to, really get involved in enforcement issues. What do you think? Are we really likely to see a big crackdown on these, or is it more of a topic of conversation?
For me, well, I think that was Amrita at Vidant that said that it might cause some more scrutiny of that in-kind redemption mechanism in itself. You really never know. You did mention this administration, which most people thought was going to be a little bit more lax in terms of some of the regulations. I think they have been in terms of bringing enforcements, where there wasn't a huge fraud. But I think on the terms of what they're greenlighting through the SEC, I think they've been kind of fair. I mean, the 2x, anything above 2x leverage ETFs, they've stopped. And they're taking a look at some of these practices, which they hadn't for a decade or more. This isn't really a new thing. Certainly, the debate isn't something new. These tax alpha strategies, now they're calling them tax alpha. That's the first time I've kind of heard that term. But this goes back a long time, since even probably before 2019 and the new ETF rule. But the new part here is that the Treasury officials are actually verbalizing it, in public and say, hey, this guys, we got, it's kind of like the first shot in the bow or the first salvo. Like, listen, either take it easy or we're going to have to continue down this path. So, yeah, I mean, it's interesting when the IRS starts realizing they're potentially losing hundreds of billions of dollars from some reports through these capital gains getting deferred. It sounds like the regulators are getting interesting. And it's like I said, it's not the first time. For years, politicians on the left have been hammering this point, especially Ron Wyden out of Oregon.
Right.
He first, I think, had a proposal in like 2021. Just last week, he introduced another bill to curtail some of this behavior inside the ETF. So you feel the knob getting turned up, the pressure getting turned up a little bit. I think their point is that this sort of strategy isn't really in the spirit of the tax code. It's these funds are getting created, especially the 351s, not for investing or some kind of alpha. It's just really literally to defer tax as the only purpose of them. So I think people are kind of like, if you can't do it outside, whatever you can do outside an ETF, you shouldn't be able to do inside an ETF and do it essentially tax-free just because you're inside an ETF. Sure, ETFs are tax efficient for that reason and others, but it just feels like it's not right. So on the other hand, I'll give you the proponent side of it and those very smart people that work at a lot of these fund managers. And, there's just so much innovation right now. And keep in mind, like, this is nothing that's not within the rules. There's nothing illegal here. This is within the tax code and the abilities that were given to them for the ETF rule. So on that side, I talked to a lot of folks, and honestly, if the issuers weren't finding these ways to get every tax penny for the investors and save every single thing, they wouldn't be doing their jobs right. If they weren't getting every single tax alpha, they wouldn't be doing, what they need to be for their shareholders and for clients. And so it's really their responsibility to be coming up with the best, most innovative tax products. And it's a lot like the Wild West. You move first and you ask questions later. And by the way, they are asking a lot of questions and information. Right. I mean, the Investment Company Institute asked regulators in an open letter about clarity for what's acceptable or not inside of these new funds. So we'll see how that all plays out, but it does feel like it's the first kind of shoe is starting to fall. We'll see when the next shoe drops and if regulators decide to do anything, or if the Treasury pushes further, or if there's investigations and hearings and public comments, which I think would be where we're heading, what it sounds like from here. So it's interesting to keep an eye on as we move into the second half.
Yeah, 100%. It reminds me of a story I did a week or two ago where the SEC made a call for public comment. I love the headline we put out. The SEC requests public comment on some of Wall Street's wildest ETFs. In that context, I think we were sort of thinking about leverage products and some other, sort of brand new things. But I could see folks writing in, about the 351 exchange issue as well. Maybe that's a good venue for folks who have strong opinions on this topic to weigh in. As I said in the prior segment, I'm a big advocate of people, reaching out to their lawmakers. I think it's also very worthwhile for people to take the time to, respond to SEC requests for public comment. I mean, they do review them, that folks who are working at that agency, that they especially appreciate letters that are like not form letters, Sean. We see a lot of people sort of kind of jump on the bandwagon and send prefabricated letters. I don't think that's super productive necessarily, but if advisors, write in their own voice and sort of share their truly held beliefs, maybe I'm naive, but I like to think that can make a difference. So I would encourage folks to kind of get involved here if they have strong opinions. And I think your point is spot on, Sean. I mean, the issuers, if they have an opportunity to save their clients money and to create high value products, they're going to do it. I mean, that's the spirit of innovation. That's kind of how we got ETFs in the first place, kind of.
Yeah, for sure. And I think to your point on writing in, yeah, and we love to see those public comment letters too, because we'll write stories about them, and sometimes there's really interesting stuff. Like the Wall Street Bets guys, I think, wrote in. That was on the quarterly earnings. Yeah. But they had a great comment letter that was it was from the heart. It was true. It was honest and brought up great points. So we wrote about that. But we not only for us, obviously, I'm sure the regulators. That's the whole point of this, to hear public sentiment on some of these things and where the public wants to see this move. So yeah, certainly fill that out. I'm not sure. To your point, I think that those public comments were more for the leverage stuff and some of those more to do with performance than on the tax side of things, but you never know. It's pretty similar. So yeah, it's going to be interesting, because honestly, I think this is the first time I remember. I wrote a story maybe a year or two ago when I first got here on heartbeat trades. Do something similar on an institutional level, and they'll just like flush in hundreds of millions of dollars of assets into an ETF and pull out the same like the next day. and it's just washing out those tax trades.
Yeah.
So I wrote about that, and honestly, everyone's like, "You're writing about it way too soon. No one's ready to talk about this. The government, regulators, they're not even looking at it. They're not touching it with a 10-foot pole right now." I feel that's starting to change. So it's exciting, and we'll see where it goes, because it's hundreds of billions potentially of dollars in taxes for the IRS. So we'll see where it goes, but it'll be interesting to follow.
For sure. I would absolutely recommend that folks read the comment letter from the Reddit Wall Street Bets group. It's sort of like a manifesto of the sort of internet investor. It gives you a nice chuckle, but there's some good points in it.
For sure.
But to kind of zoom out, Sean, I think like what this discussion really revolves around is the fact that, there's a lot of innovation happening, but the fact of the matter is that rules can change, and sort of the greatest danger here, I think, is actually uncertainty, and investors really need to be aware of the techniques they're using, and certainly, if at the very least comply with the letter of the law, and hopefully the spirit of the law as well. So that's sort of where I see this heading. But we've seen this tension play out with derivatives, all sorts of structured products. I mean, cryptocurrencies, private markets, now tax-aware ETFs. Prediction markets, Kalshi, poly market. I mean, this is a super interesting time to be just reporting on the ETF marketplace, but it's kind of hard to see where all this goes. But I think we can conclude, Sean, is that we'll certainly have a lot to write about in the ETF Upside newsletter in the months and years to come.
Yeah. We got our work cut off for us. That's for sure, John.
100%. Well, folks, if you have thoughts on this, reach out to us directly. We'd love to understand how you're using these products. If you're an advisor who's maybe taken advantage or helped clients utilize a 351 exchange, we'd love to hear about that. I'd also say, Sean, as a reporter, it's fun to speak with people sort of on background and even off the record sometimes too. So even if you don't, want to tell us explicitly about something a client did that, for publication, we still want to hear from you. I mean, it can be very helpful to understand how folks are using these sort of strategies and techniques, and we'd love to even have more background conversations as well if that's something that listeners are more comfortable doing. So just wanted to throw that out there.
All right. Well, thanks everyone for listening. We had fun. I know I had fun, John, kicking around some ideas with you about some trends that are happening. We hope you enjoyed it too. Listen in the next couple of weeks. We'll have some top CEOs joining us and some really fun guests to bring on, which are great insights, and I'm sure you're going to learn a lot. We're on all platforms, so anywhere you get your podcast, come check us out, follow, like us, leave reviews. We love to hear from you. And John, anything else you want to add?
Yeah, if you want to get involved, email us at podcast@thedailyupside.com. We'd love to include guests. This was a fun episode with just you and I, Sean, but I really enjoy when we bring on guests as well. We've had some great ones already. Our calendar is pretty jam-packed coming up in the next couple of weeks. As you said, we've got some great guests that will be joining us. And I've really been having fun doing the podcast, Sean. I think it's a great complement to what we do, day in and day out here at the Daily Upside, which is produce accurately reported newsletter content that really should be of high value to the financial advisor community. So if you subscribe to all our newsletters, we like to think that you'll really get a holistic, up-to-date perspective of what you need to know as a financial advisor or, general industry professional as well. So, of course, we have the flagship Daily Upside newsletter, which we're proud to say has over 1 million subscribers. We have the business-to-business publication, so to speak. We have the Advisor Upside, from which this show gets its name. We have the ETF Upside, and then we also have the newest one, the Retirement Upside, which is near and dear to my heart as a retirement reporter. But I do love all the newsletters, to be clear.
You can't pick favorites, John. They're like babies. You can't pick your favorite.
That's true. I guess I should keep that to myself. But in any case, we'll go ahead and wrap up the episode here. Sean, hope you have a good one, and we'll be back again soon.
Thanks, John. Take care, everyone.